Folks, markets are at a critical pivot point. There's just no denying it. I expect stocks to transition away from the bull mode we're in right now to more of a choppy, range-bound cycle. It's going to happen, folks. Just about every indicator that I trust is signaling that that's going to happen. Today, I'm going to show you what I'm seeing and the best way to take advantage of this type of market. It's trickier to trade than you might think. All right, folks, let me give you the case for why I believe the markets are going to get a little choppy. Now, again, am I expecting a major sell-off? No. Am I expecting a market crash? No. Am I expecting for the market to fall apart? Not even close. All I'm expecting is a minor pullback because stocks are overbought. It's like imagine yourself running around the block a few times. You're going to get tired unless you're a professional runner, which I imagine most of us are not. I'm definitely not. So you're going to get tired. You're going to want to take a break. You're not going to be able to run another 2 blocks till your body rests. Markets work the same way. So let me show you some compelling evidence to show you that bulls are a bit too excited for their own good right now. This is the put to call ratio, and this tells me when call buying gets extreme or put buying gets extreme in comparison to puts. So you're always looking at a ratio. Typically, this is useless. This indicator is useless and it's random. But right now, whenever you see the put to call ratio of below 75, and it is right now, it's been there a few days already, it's telling us that call buyers are getting a bit too excited for their own good. Incidentally, whenever you see the put to call ratio get above 120, 125, it's telling us that the bears are getting a little too nervous for their own good. So this is something important, something you want to pay attention to. So again, put to call ratio is telling us that bulls are pushing that envelope as much as they can. They're pushing that market higher. They think markets are never going to go bearish. They're really, they just think markets are going to continue moving higher and higher and higher and higher. And earnings have been good. Earnings have been better than expected. But most investors and traders don't realize that they've been beaten down before the fourth quarter began. So it's kind of like the expectations were so low that it was hard not to beat them. I'm going to say it as it is, and I usually do. So the put to call ratio is getting a little over bullish here, and usually when that happens, markets pull back. Now, again, I'm not saying that the market's going to go all the way to bearish territory, but I think it's going to go back to neutral territory, which is what happens 95% of the time. Which is why I say this indicator doesn't do much except when you see extremes, and you see extremes when it's below 75 or above 120, 125, which happens at times. But again, we're seeing that now. That's number one. Number two, this is the percentage of stocks in the NASDAQ 100. There's 100 stocks, 100 of the biggest growth in tech stocks. Amazon, Netflix, NVIDIA, Facebook, all that is inside the NASDAQ 100. So we're seeing 85% or 85 stocks, because 85% out of 100 is 85. We're seeing 85 stocks trading above the 200-day moving average. Now, that's a great thing, and that's a really bullish sentiment, but look here, this is a 5-year chart. Every time the number gets to 85% or close to 85%, like right here, like right here, like right here, like right here, it tends to cool off. And guess where we're at right now? We're back there. And this is not like an intraday chart full of noise. This is a weekly chart that's giving you 5 years of data, all right? 5 years of data. So again, I want you guys to understand and I want you guys to realize exactly what I'm seeing and why I'm telling you what I'm not just saying markets are going to go down or sideways and that's it. No, I'm explaining to you. I'm showing it to you. You can pull this up on your own chart, on your own. This is free. This is bar chart. So again, that's number two. And third, the third reason is we're seeing divergence. This is price action. Notice the S&P 500. We're seeing prices head higher. The highs are getting higher. But look at the oscillator. This is a 10-day modified RSI oscillator. It measures momentum. So we're making higher highs, but the momentum can't generate those levels. And that's telling us that the market levels are overbought. So you've got the percentage of put to call ratio. You've got the percentage of stocks in the NASDAQ 100. 85 stocks are above the 200-day moving average, which tells us you really don't have a lot of places to go higher from that point. You don't want to be a buyer at those levels. You may not want to be a seller, but you definitely don't want to be a buyer. Markets are a little too hot right now. And again, lastly, we're seeing divergence, and divergence tells us that the momentum level that price is able to generate the momentum levels cannot be sustained in the oscillator. And actually, this oscillator tends to work really well with the modified version, 10 days instead of 14 days. It tends to work really well with stocks. I like it for stocks a lot. I use it all the time. But divergence analysis is actually even more valuable, and you don't have it a lot. It's even more rare than seeing overbought or oversold levels. So there's positive divergence, there's negative divergence, but I wouldn't remember that. I would just remember that whenever you see the oscillator move higher and price action not move higher, or whenever you see the oscillator make lower highs and price action makes higher highs, it's telling us that momentum levels are overbought and that rubber band is stretched out. So when you're looking at put to call ratio, percentage of stocks or number of stocks, 85 stocks in the NASDAQ 100 and the S&P 500, and remember, all those NASDAQ 100 stocks are in the S&P 500. So when you're seeing them, 20% is also overbought, and that's going to have a huge market cap on the S&P. So all of this is telling us and pointing at the same thing. We're going to have a little cool-off period. Now, here's the thing. This doesn't tell me how long it's going to be for. It doesn't tell me if the market's going to go down for a long time or not. It's just telling us markets are tired. And usually when we see this, especially when the economy is stable, and it is right now, usually when we're seeing this, we'll typically have a pullback to the 50-day moving average. Sometimes we'll go to the twilight zone between the 50 and the 200-day moving average, and then we'll pop back up. Again, put to call ratio, number of stocks in the NASDAQ 100, and divergence in the S&P 500 are all telling us that choppiness and sideways trading action is going to be coming up very soon. Folks, this is important stuff, so pay attention. The put-to-call ratio is signaling that traders are getting a little too exuberant, especially when you consider that 85%, that's right, 85%, that's 85 out of 100 NASDAQ 100 stocks are trading above the 200-day moving average. Folks, that's not a spot many rallies start from, okay? In fact, quite the opposite. Extreme exuberance plus overbought market means I expect stocks to cool off for a while. Now, don't get too excited. That doesn't necessarily mean a steep sell-off. Instead, I see stocks entering a range-bound cycle, choppiness over the next few weeks at least. Now, that's why I'm expecting the next 197 days or so to be critical. Things are about to change, folks. I'm telling you, it's going to happen. Prepare yourself. And if you want all the details, get this. I've put together a new comprehensive report called Diamond Roadmap. It takes you through how I see the next few months playing out and how you can take advantage of it. With the right strategies at your disposal, I think we have the opportunity to make money in the next 200 days or so. More than most investors make in a decade. I really, really mean that. Follow the link below. Get in on it now. Check out the Diamond Roadmap. Do it today.